Hello friends, we'll be discussing an illustration which we spoke about, rather the interest on drawing being a part of average due date calculation. We'll be doing an illustration reference to the same. So when we know about interest on drawing now, which is being charged on the different amounts that are taken by the business people or rather the business person during certain time interval, and we have to figure out how the interest is supposed to be charged under two systems. One is the ordinary system and the second is where average due date can be utilized. So let's figure out an illustration whereby both systems can be used and the difference can be compared there. So the question has been mentioned for your reference. A and B are two partners of a firm. They have withdrawn certain amounts of the firm or rather from the firm in the year 2015. The closing of the year is 31st of March 2015. We have the respective amounts, that means the date and the amount withdrawn by A and the date and the amount withdrawn by B respectively. So the amount withdrawn by A has been also mentioned there. And the amount withdrawn by B also has been mentioned. The date and the amount has been mentioned here. So for A it is 1st of July, 30th of September, 1st of November, 28th of Feb, where the drawings have been made. And similarly for B we have certain dates like 12th of June, 11th of August, 9th of Feb and 7th of March respectively, and the corresponding amounts also have been mentioned. The interest is also chargeable at the rate of 6%. We have to calculate the interest chargeable if ordinary system is used and if the average due rate system is used. So let's figure out how to get it done. We'll be using the ordinary system first to determine what is the interest that will be charged for both A and B. So we have prepared a format whereby we have taken the columns like date, amount, number of months or number of days from when the loan was taken or rather the drawings were done and the amount here. Now the amount will be a total of number of months multiplied by the amount taken. Now for your reference, if the first drawing was done on 500 or 4 rupees 500 on 1st of July. So from 1st of July until the closing year, that means 31st of March, how many months do we exactly have? July, August, September, October, November, December, Jan, Feb, March. 9 months to be precise. And we've taken the July whole month because this drawing was done on 1st of July, hence. The way we figured it out for the first, we'll do it for the next two as well or rather next three as well. So we've done the calculation of the months. Let's figure out what is the product. That means number of months multiplied by the amount taken. Now, if you can see, the total withdrawal has been 14,700. Now, the interest that is supposed to be charged is for 6% per annum. 6% per annum is the withdrawal, that is the interest that is supposed to be charged on the withdrawal. Now, if you take or if you divide it by 12, that means it is 0.5% per month. That is the interest that will be charged here per monthly basis if you divide 6%, because 6% is per annum. So let's figure out how much is the monthly interest that will be charged if it is 0.5%, and how much is the annual interest that will be charged. So the per annum interest is 882 rupees and the per month is 73.5 rupees. This is the interest that has been calculated as per the normal ordinary system. We'll do it for B as well, but for B, instead of months, we'll take number of days here. Let's figure out if there is certain difference here or not. For B as well, we have mentioned the date as well as the amount. Now, for a reference here, we have taken days and not months. Hence, what we'll be doing is that from 12th of June, for example, the first transaction that refers here, the first withdrawal for B was on 12th of June for an amount of 1000. Now, from that day, from 12th of June until 31st December, or rather 31st March here in this question, because the closing is on 31st of March. So, from 12th of June until 31st March, how many days are there is what we'll be putting it down there. So, let's figure out how many days do we have exactly. To be precise, we'll have somewhere around 292 days. Similarly, we have to calculate it for each and every withdrawal here. Now that we have mentioned the number of days until 31st of March from every withdrawal date, we have to figure out the product. Now the product will be the number of days that we have calculated multiplied by the amount withdrawn. So that will give us the product here. Now, as you have taken it one day, that means if you recollect the earlier thing, we calculated per month interest because we have taken months there into the question. Now here we have taken days, so we have to figure out per day how much it is that we are going to charge as an interest here, because the calculation of the base variable here itself is in days. So we'll take that into consideration. 1 year is equal to 365 was our assumption, so we'll take as per that on the product, which is 4,49,600. So as per the ordinary system, A and B interest has been figured out per day and per month as well, because for per month it is A, per day it is B, and we have figured out that total now. Now, if we use the same thing in average due date system, let's figure out whether we have something similar or whether there is completely different answer, or whether that method is completely easy in terms of calculating the interest here. Let's figure that out. This is the closure of ordinary system. Let's start with the average due date system now. Now in this situation, while calculating the average due date, we have taken three assumptions just for your reference. Now, the base date can be calculated, or the base date can be 3 days basically. First, that is 1st of April, that is the start of the financial year, because the closing is 31st of March. So we can either take 1st of April as the start date, or we can take 1st of July as the start date, which is the first transaction withdrawal of A, and 12th of June as the start date, which can be the first transaction withdrawal of B. So either of it can be taken, and using this the average due date can be figured out. But in this situation we'll be using all these three scenarios so that you can understand where exactly or how exactly the calculation has been done. So in this scenario we'll be taking the first situation, rather we'll take 1st of July, that is the first transaction date of A as the first situation, then 1st of April whereby the year start, and then the first transactional date of B, so that we are on the same page. So let's understand with the first transactional date of A, what is the interest that is charged here. So we have mentioned the dates, we have mentioned the amount as well. Now we have to go ahead and figure out how many months from the base date. Here the approximation or the appropriation that we have taken, that is either the start of the year date or the first transactional date, his can be taken only for A, because for B we have done the calculation the number of days, so that will be completely different. Here the appropriation that we are taking is only for A itself. So if you can see, the first transaction, that is 1st of July was the date, and the base date itself is the same, so 0 months. Now the second transaction is on 30th of September and the base date is 1st of July. So 1st of July, that July whole month, August whole month, and the September whole month will give you 3 months from the base date. So that is what you have to mention there. So we've mentioned the months as well. Now we have to go ahead and figure out the product here. So we've mentioned the formula as well, which is base date plus product upon amount. Let's figure out what is the average due date that is coming, and according to that date itself we'll figure out the interest here. So the calculation that is coming is 3.556 months. That means 3 months is for sure. So July gone, August gone, September gone. Now the next month is October. So that has to be taken into consideration. That is somewhere around 3.5 months that they're taking. So for October, how to go ahead and calculate the number of days? So that will be a rough approximation that will be taking, because if you see it is 0.556, 3.556 is what the calculation is. So 0.556, if you multiply it by 100, that will give you around 55.6% of days are taken into consideration. So October has 31 days. If you multiply 31 days by 55.6%, that will give you a rough approximation of 17 days, 17 point something. Hence 17 days are completely considered. Hence here the due date will be, average due date rather, will be 17th of October. Now the interest that has to be charged is only after this date until closing date, that is 31st of March. Only for that many days you have to charge the interest. So let's figure out how much is the interest that we have to charge on the amount, that is 2700, not on the product though. Now if you can see, we have mentioned the amount 2700 multiplied by 6 upon 100 multiplied by dash upon 12. Now that specific dash or the blank has been left to calculate how many months exactly from October 17th to 31st of March. So if you skip October, you have November, December, Jan, Feb, March. 5 months are already there. So of course there will be something after 5. So let's calculate that. So let's take an assumption like 1000 out of 1000, because the calculation was into hundreds. The percentage that we did is 55.60 percentage. So out of 100, 55.6 is already considered. Whatever is the balance will be taken into approximation. So that comes to 44.4 into percentage. If you again remove the decimal, that will be 444. So approximately 5.444 months that has been taken into consideration here. So the interest charge is 73.49 rupees. Now this is as per the calculation. If you have taken 1st of June, or rather the first date or first transaction of A of withdrawal as the base date. What happens if for A itself we have taken 1st of April as the base date? How the calculation will go is what we have to understand. So let's do that now. Now the question remains as if we have taken 1st of April as the base date. Again the same columns, only the months will change here. Now from April until the first transaction, that means of 1st of June. So April, May, June. Here we'll have to take considerations like that. The first transaction that happened was on 1st of July. So 3 months from April, because 1st of July comes only before June, May and April. So 3 months have been taken into consideration. Similarly, we have to do it for the other months as well. Now that we have figured out the number of months, let's take the product, that means amount multiplied by months. So the totals of product and amount has been taken into consideration. Let's figure out how many months it is which will be added to the base date. So it again comes as 6.556 months. That means from April you have to add 6 months for sure. So from April, so April month, May, June, July, August, September. Till September you have to take into consideration. The other 0.556 days again will be as per the same calculation that we did earlier, which is 17th of October. So again the interest that will be charged from 17th of October until 31st of March on the same amount, which you know of course what is the amount that will be. So the interest that is charged here is 73.49 as per the case study that we have taken K, or rather the case study that we have understood right now. Let's take the other scenario whereby we have taken B situation into consideration now. Now we shall take the next case, that is taking 12th of June as the base date. That means taking B situation into consideration. Now here the base date has been considered as 12th of July. We have mentioned the same columns here. The only difference is that wherever you used to take months, we have to take days now. So for the first transaction, that is 12th of June, the days will be 0. Now the next transaction that will come from 12th of June until the next transaction date, how many days is what we have to consider, and we'll keep doing that until the last transaction. Now that we have the total of all the transactions, rather all the days, let's find the product, that is multiply the number of days into the amount. So the total is 131 days after the specifications that we have taken. That means 12th of June. So let's figure out after 12th of June how many days do we have to take care of to understand what is the due date here. We have taken only until September right now, just to see whether we have to, or is there any need ahead of taking any further. For the 3 months, that is July, August and September, we have total of 92 days that has been already covered. Let's take the balance of June that is left. 18 days of June have been already covered now. So if we can see 92 plus 18, let's figure out how many days have been covered until September. 110 days have been covered. That means the rest 21 days will be from October. That means 21st of October is the due date here. So if 21st October is the due date, let's figure out how much interest is supposed to be charged from 21st of October until 31st of March. So from 21st of October until 31st of March, we have approximately around 161 days. So the interest that will be charged here is 74.1 rupees. So rather, this is how the interest is supposed to be calculated during different methods or during using certain different methods. I hope this video has given you a lot of clarity about how to go ahead with such kind of methods. So thank you for watching this video. Stay tuned with Ekeeda and keep subscribing to Ekeeda.